Well, thanks for having me, Arabile. This is what a year-end chase looks like when 65% of managers are behind their benchmarks. They certainly ran the Grinch out of town this year. But we have to keep in mind, certainly the recency bias. We have come a long way in a short period of time in the last couple of months. But if you look back and zoom out a little bit, over the last 2 years since 2021, the returns for the S&P 500 are basically zero. We're just now breaking out to new highs, and it's very tough to short new highs. There is kind of a consensus that after moving so far so fast, we have to have a correction of 5 or 10% in the first quarter. I wouldn't get too cute with it because the underlying economics look pretty well. The key is going to be finding the opportunities under the surface versus chasing the indices.
Yeah, so what makes sense then on that interest rate front in order to keep this market sort of bubbling in the right direction, or in this direction, shall we call it then, right? I mean, what sort of interest rate environment are we looking at? The kind of tone as well that comes out of the Fed. What clear messages do they need to send to get the market still moving?
Yeah, well, the Fed is still restrictive. Their dot plot is showing, 3 cuts in 2024. The market, the Fed funds future, is showing 6 cuts. So there's a pretty wide spread there. And if you look at the Fed is still extremely restrictive. When you look at the Fed funds rate, 525 to 550 relative to core inflation, there's over a 200 basis point spread. So that's still very, very restrictive. I think as they see the disinflation continue to kick in, they will move ahead with the cuts. The market is going to like that. And what's interesting in the US is everyone was looking for a recession in 2023 that had already happened in 2022. The first 2 quarters of 2022, we did have a technical recession with negative GDP. So CEOs went in the year of efficiency in 2023, cutting costs, running lean operations. So I think the story for 2024 that no one's looking at, besides earnings growth of 12%, is going to be margin expansion, margin reacceleration of 60, 70 basis points, which no one's prepared for. So the earnings might actually be a little light, even if the multiple is pretty expansive at 20 times forward. There are tremendous opportunities under the surface, relative value in small and mid cap space, which is only trading at 14 times forward earnings.
Thomas, can we talk about the relevance of positioning and sentiment here? Because if we take a look at your chart as to the extent of the rally, we know it's aggressive November, December, but still we are coming off lows. So what's the relevance here of that sentiment and positioning as we enter 2024?
Yeah, Karen, that's a great point. In the U.S., Bank of America does a global fund manager survey every month. And what we actually notice is that when asked about improving growth, yes, sentiment is turning up, but it's barely coming off the mat. It actually resembles the type of sentiment we saw in the summer of 2020, just coming off the COVID lows, and in the summer of 2009, just coming off the great financial crisis lows. So people are not exuberant at the institutional level. That's number one. Number two, in terms of the amount of risk that they're taking in their portfolios, again, it's looking just like summertime 2020 and summertime 2009. So there's a lot of runway ahead. And that's why we say, yes, you may get a little consolidation and a little volatility in the first quarter, but I wouldn't get too cute with it. There's still tremendous amount of opportunity, particularly outside the Magnificent Seven. And if you look at the presidential election years in the US, which 2024 is one, on average since 1928, the market's up 11.28%. And in years where a sitting president is running for re-election, the market's up 13%. So we are looking for high single digit, low double digit in the indices and more opportunities under the surface.
Thomas, we may